Confused about mutual fund returns? Wondering what terms like CAGR, XIRR, and absolute returns really mean? In this video, we are going to break down these essential return metrics and explain how to use them to make better investment decisions. Whether you're a beginner or experienced investor, understanding these terms is crucial to evaluate how your mutual fund is performing over time. At Stack Wealth, we offer customized mutual fund portfolios called stacks designed to deliver higher returns than the regular mutual funds. Our dedicated wealth managers actively manage and rebalance this portfolio based on the real-time market conditions to help you achieve your financial goals. Do you know your mutual fund actual returns? Drop a comment below and let me know what return metric you use. Let's start with absolute returns. Simply put, this is a total return your investment generates over a specific time period. It's calculated by subtracting your initial investment from your final value, then dividing by your initial investment. For instance, if you invested rupees 1 lakh and it's now worth rupees 1.2 lakh, your absolute return is 20%. This is great for evaluating how much profit you have made in a given period. But here is the catch. Absolute returns don't consider the time factor. It doesn't tell you whether the 20% gain happened in 1 year or 5 years, which is important for long-term investments. Absolute returns are useful for short-term or single-period investment where time isn't a key factor. At Stack Wealth, our wealth managers look at absolute returns to evaluate the short-term performance of your portfolios. This helps in making quick adjustments and rebalancing your portfolio if needed. Now, let's talk about CAGR. Compounded annual growth rate. It's the average annual return that tells you how much your investment has grown per year over a specific time frame, assuming the profits are reinvested. This is the formula for CAGR. CAGR is equals to ending value by beginning value to the power 1 divided by number of years minus 1. If you invested rupees 1 lakh and after 5 years it's worth rupees 1.5 lakh, the CAGR is approximately 8.45%. This gives you a much clearer picture of your investment's yearly growth rate. CAGR is ideal for understanding long-term growth because it smooths out the ups and downs of short-term fluctuations, providing a more accurate reflection of performance. At Stack Wealth, we design our customized portfolios to achieve a high CAGR. By carefully selecting a mix of top-performing funds, we tailor your portfolio to meet your specific financial goals. Now, let's dive into XIRR or Extended Internal Rate of Return. XIRR is more advanced return metric that accounts for irregular cash flows like those in systematic investment plans, where you're making investments at different points in time. XIRR helps you measure returns for investments where you're not making a single lump sum investment. It's perfect for SIPs where the amounts and timing of your investment change regularly. Let's say you're investing 1,000 rupees monthly for 13 months and at the end you receive 14,500 rupees. XIRR will give you a return that accounts for each monthly investment as opposed to simple average. For this case, XIRR would be 19.8%, a much more accurate reflection than absolute returns or CAGR. Our wealth managers use XIRR regularly to track the performance of SIPs and suggest rebalancing strategies based on this more precise return metric. Let's understand when to use each metric. Absolute return is best for evaluating short-term or single-period investments. CAGR is ideal for understanding long-term, compounded growth over several years. XIRR is perfect for investments with irregular cash flows like SIPs where you contribute at different times. At Stack Wealth, we ensure that you're using the right metric for your portfolio, whether it's absolute returns for quick checks, CAGR for long-term growth, or XIRR for SIPs. Our wealth managers help you make the right decision based on your strategy.
Alright, so we're going to do a little live demonstration to understand the difference between absolute returns, XIRR and CAGR. So obviously so far you know that CAGR is suitable for short-term investments. If you just want to see how much returns you've gained in percentage from the starting to the end without considering the time in between, you go for absolute returns. For example, your starting value was 1 lakh, your ending value was 1.2 lakh. In that case, your absolute return is 20%. Or as you can see, we have an example right here. If you invested 10,000 and now it's 15,000, the absolute return is around 50%. So that is great, but that doesn't give you the picture of how much your investment grew on a yearly basis. So when you want to know how much your investment grew on a yearly basis, you go for CAGR. So if you take the same example, if you invested 10,000 rupees, grew by 15,000 over 3 years, then the CAGR is 14.47%. This means that the investment grew on average 14.47% every year for those 3 years. Now, obviously, this doesn't necessarily mean every 3 years was 14.4%. It means that on average. So, what it could be is that 1 year it was 17, 1 year it was 12, 1 year it was 14, 15, right? The average is 14.47%. That is something that you should keep in mind. Next is XIRR. Now, obviously, XIRR, the formula for XIRR is quite complicated. So we won't get into the formula exactly, but calculating XIRR on Excel is very simple because it's just a function. But how XIRR is used, let's take the example of this one, which is if you invested 5,000 initially and you added rupees 2,000 after 1 year and withdrew 7,000 after 2 years, the XIRR, you can't use CAGR or absolute returns. You have to use XIRR and you have to mention the timestamps. The timestamps are very important when it comes to XIRR. So now let's look at these examples with a calculator. We have a very simple setup over here. So as you can see, we have a beginning, let's do absolute returns first. If we're looking at absolute returns, we have a beginning value of 10,000, 15,000, absolute returns are 50%, right? Let's play around with these numbers. Let's say that the first initial value was 25 lakhs, right? 25 lakhs, and the ending value was, let's say you went into a loss and now your value is 24 lakhs and let's say 50,000, right? So your portfolio went down by 2%. Now, is this 2% in 10 years, in 5 years? No idea, because we're not looking at that right now, right? Let's say if you went into a profit and let's say you now have 32 lakhs, your portfolio went up by 28% in that case. So this is very simple. Obviously, absolute returns is not a very complicated thing to understand. Moving on, let's look at CAGR now. In the same example, we have the beginning value as 10,000, your ending value as 15,000, and you let that investment sit for 3 years. So on average, it grew by 14.47%. Very simple. One thing to keep in mind is this is, again, we are talking about lump sum investment. We are not talking about an SIP here. You just invested 10,000. After 3 years, it's 15,000, right? Now let's mess around with this. Let's say your beginning value is, again, let's look at the same example, 25 lakhs, right? 25 lakhs and your portfolio went down to 24, whatever, I don't remember the exact number I put last time, but we'll put something similar to it. And let's say this happened in the case of 1 year. So then the CAGR is 6% right? Now let's increase the duration and say, so you had a 25 lakhs of lump sum investment, and let's say after 5 years, let's say the economy is not doing really well, something really bad happened, and Nifty has been steadily declining, then after 5 years, your value is lesser, it's 23 lakhs, 50,000. And that means the CAGR was minus 1.23%. All right. So now let's look at a positive scenario. Let's say you had a 25 lakhs investment, right? Let's round it off and make it 50 lakhs. That'll be interesting. Okay, 50 lakhs. And your ending value, let's say you have done really well. And now your portfolio is worth 75 lakhs. And this, in a matter of 5 years, is very, very unrealistic. So let's go for something like 10 years. Now, 10 years also might be too much. Let's say it is 7 years. Then in that case, the CAGR is 5.96%. But I think we can, let's try something where the CAGR is 12%. Sorry, CAGR is 12%. So that means let's keep 10 years. and let's keep it 1 crore. 7.8%. Again, yeah, there you go. So if you had an initial investment, lump sum investment of 50 lakhs, and let's say you are putting it in a portfolio where you're hoping the CAGR is 12%, then if you let it sit in, if you have obviously done your due diligence and the diversification of your portfolio, all that, and of course you have to rebalance your portfolio, all that aside, uh, that 50 lakhs investment, if you are expecting a 12% growth year on year and you keep it for 10 years, after 10 years it will be 1.6 crores. So that is the value, that's the point of CAGR. Now you understand the difference between CAGR and absolute returns. You have a clear understanding with the duration taken into account. Now finally we are moving to XIRR. So XIRR of course is a little bit more complex. As you can see here, we are not looking at, I mean we are looking at duration, but more importantly we are looking at when the investment is made in that time span, sorry. So just let me set this up quickly. 10,000, 10,000. Okay. Okay. So, okay, I will explain to you what is happening in this Excel sheet. So the fact that you can see 10,000, so this, let's say the first investment of an SIP. Now, what is an SIP? You're making an investment, an equal investment or maybe non-equal, whatever, every month. Okay, every month you're making an investment. In fact, you can forget SIP also. Let's say you're a salaried person and you're making an investment every month, but your investment value is changing because your expenses are changing. Maybe 1 month you're spending a lot, so you're investing less. 1 month you're spending less, so you're investing a lot. So XIRR is great to give you an idea of how your investments perform, even if you invest on an irregular basis, right? So the whole point of XIRR is irregular cash flows to understand how your investment performed if your investments are irregular. So we are right now starting our first investment on 1st January 2021, right? The investment of 10,000 rupees, right? Ignore the fact that it says minus over there, not important. But that is 10,000 rupees investment on 1st January 2021. Now let's say we continue this investment for the entire year till uh, the next year January, and yeah, till the next year January. Give me 1 second. Sorry about this. Yeah. Okay. And next year January, and then you take out the money on February. So you started investing 1st Jan 2021. You invested 10,000 continuously for an entire year till 1st Jan 2022, and then February 1st, 2022, you take out your money. All right. Now the fact that because you've been investing 10,000 every month for 13 months, your total investment is 1.3 lakhs, 1,30,000, right? That's your total investment, as you can see over here. And because your investment did well, you gained some returns of 50,000. So that means on February 2022, you took out 1.8 lakhs, correct? So what is your XIRR? It's 70%, right? So this is, imagine if you did an SIP for 13 months, and after the 13 months, you got your total investment is 1.3 lakhs and you got 50,000 in returns. It's great. You don't see this normally. It's very unrealistic. In a more realistic scenario, something that you would see is maybe 1.5, right? So that means your returns are 20,000. Your total investment was 1.3 lakh, and your XIRR is 27%. This is normally something that people see when it comes to 1 year, right? If you took the calculation for more than 1 year, maybe you'll see something better. But because it's 1 year, this is a more realistic example. Now let's try to understand what is the benefit of XIRR, right? Okay, let's keep in mind our total investment right now is 1.3 lakh, and our XIRR is 27%, right? This is because of the way we have regularly invested 10,000 rupees every month. Okay, that is why. Now, what we're going to do is we are going to make sure that the total investment is still 1.3 lakh, but we're going to play around with the numbers a little bit, right? where let's say you didn't invest in February, or in March you invested like a lot of money, right? In March you invested 30,000, and then in this month you didn't invest again, and then in this month, let's say you skipped 2 months over here, you skipped this month and this month, and then this month you planned on investing 20,000, and then this month also you planned on investing 20,000, right? So again, your total investment is still, give me 1 second. There you go. Now, again, your total investment is still 1.3 lakh, as you can see, and the returns you gained also were 20,000. But look at the XIRR. The XIRR has increased. And why is this? Well, I can't tell you completely. I can't tell you it very clearly why the XIRR is higher, but in a very brief way, I can tell you most of the investments were made in the later half of the year. As you can see, from October onwards, you've invested 20, 10, 30, that's 50, and 80. Okay. And in the beginning of the year, you've invested only 30, 40, 50, right? So the fact that you invested most of your corpus at the end of the year and you gained such high returns and lesser in the beginning of the year, that's why the XIR is higher. That's a bit it's a bit difficult to understand, but it basically tells you that this investment performed really well, right? Because if you let's say you made the entire investment in the beginning, as you can remember, the first case when we made 10,000 rupees investment every month, the XIRR was around 27%, right? So now let's try to go for a very unrealistic. I mean, not unrealistic. Sorry, a very the outlier case, as some would say, right? So let's call this 0, 0, 0, 0. Great. Now look at that. The XIRR is lower. Why? Because you made the investment much earlier, right? So as you know, with the power of compounding, if you make an investment earlier, and you will obviously get better performance. But if you made an investment today and tomorrow your returns are so high, that means that investment is great, right? That's what XIRR tells you. XIRR tells you how the investment performed based on when you made the investment, right? So now I hope you understand the difference between absolute returns, CAGR, and XIRR. Absolute returns is useful for, I guess, short-term investments when you want to see how an investment performed in a few months. CAGR is useful for long-term lump sum investments, and XIRR is useful for SIP investments.
To recap, absolute returns, CAGR, and XIRR are three essential metrics for evaluating mutual fund performance. Absolute returns are best for short-term checks. CAGR is perfect for long-term growth, and XIRR is key for SIPs and investments with irregular cash flows. Do you track your mutual funds returns? Which metric do you prefer? Comment below. I would love to hear your thoughts.
Stack Wealth is a new age investment management company that helps you take your wealth to new heights. Our team consists of experts with 25 plus years of experience managing investments for more than 1 lakh investors. Our team of experts help you curate a personalized mutual fund portfolio based on your goals and risk tolerance. They help you decide your asset allocation. They also help you identify high performing sectors to help you generate additional returns. And finally, we help you manage and monitor your investments in real time. First, download the StackWealth app from the Play Store or App Store and complete your sign up by entering your mobile number and email ID. Now you can explore the app, get your personalized mutual fund portfolio, or browse our various investment opportunities. To start investing, you have to complete your KYC. Once your KYC is completed, you can start investing in your personalized mutual fund portfolio or explore our expert curated investment opportunities. If you're not sure where to begin, your dedicated wealth manager will help you. Now you can start an SIP or make a one-time investment. Remember, you can always pause your SIP anytime and edit the SIP amount if you want to increase or decrease it. Finally, you can sit back, relax, because our wealth team will rebalance your portfolio based on shifting market conditions, identify and recommend new investment opportunities, give you monthly portfolio reports so you know exactly how your portfolio is performing. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and tap the bell icon to stay notified, because we are making finance and investing as simple as possible for everyone. Thank you for watching, and goodbye.